Hello and welcome. We are taking stock of earnings from Tech Mahindra, a very steady quarter coming through for the company. And well, at least as far as your revenues are concerned, they were ahead of consensus expectations. Well, to take us through the quarter gone by and what we can expect going forward, we're in conversation with the CFO of the company, Manoj Bhatt. Manoj, thanks for joining in, taking the time out. If you could just tell us about what has led to the growth essentially, and to what extent is this with, some of your large deals. Of course, we will have AT&T in the conversation, but if you could just tell us about the growth for this particular quarter and what are the factors that have aided strength here.
So thank you, Adam. I think we have had a very satisfying quarter. I think if I look at the highlights, I think it's a record quarter of deal wins for us, about $1.5 billion or so in terms of deal wins. The second thing is, if I look at the growth in digital revenue, I think we are hitting 39% of revenues. So again, the momentum continues in that aspect. And third is, of course, we continue to add to our capability set. We just announced the signing of an agreement with the Bond Group, which is e-commerce and digital strategy firm, which we announced this quarter. I think coming to the numbers, I think clearly good all-round growth across verticals. The only vertical I think where, as we had indicated, there's a certain slowness in the auto segment, but apart from that, it's been very good all-round growth. Even if I look at a geography cut, on a constant currency basis, we grew across all parts of the globe in terms of our operations. During the quarter, of course, Europe, for example, saw some cross-currency headwinds, but adjusting for that, I think there's been good amount of growth. So if I look at the quarter from that perspective, it's in line with what we were thinking in terms of a strong funnel being converted, and that is resulting into revenue growth. And that's something which we expect that will continue going into the future also.
Okay, great. That's good to know, Manoj. Well, if you could also tell us about operating margins. Now, there were all sorts of guesses that there could be some amount of pressure on margins given the kind of investments that the company may have to take up. That's not clearly come through, and well, we've seen an expansion in operating margins. So, firstly, if you could tell us and perhaps quantify all the factors that worked for and worked against margins for Tech Mahindra, and perhaps if you could also give us an idea about in future, could there be more investments in store based on the kind of deals that you guys have signed that could lead to some pressure as far as operating margins go?
So if I look at operating margins from Q2 in Q2 compared to Q1, of course we have had some efficiencies come through, which is about 100 bips positive side on the margins. We've also had visa costs, which is usually in Q1, that is absent in Q2. I think those are the two main positive levers. I think on the other side, we have had a little bit of a small portion of employees who are on the Q2 salary hike cycle. So there's been some small impact of that. But if I look at going forward, I think while we'll continue to work on 2 or 3 main margin levers, one is of course synergy with portfolio companies. That remains a big element of something we are trying to do on a continuous basis. The second is usage of automation, not only for internal operations but also for client engagements. And last but not the least, I think in terms of our overall operational and SG&A cost and how we continue to focus on bringing that down in line with our objectives of continuous improvement across all parts of operations. But on the other side, as I look at the next 2 quarters, we are going to go in execution mode in some of the recent deal wins, and there is an associated costs of actually transitioning, which will impact margins in the next 2 quarters. So if I look at probably normalizing that, I think that normalization will happen in FY21. In FY20, I think we will see just the sheer momentum of large deals is going to depress margins as over the next 2 quarters. So on an overall full year basis, FY21 you will see the margins go up, but FY20 I do believe that compared to last year, the margins will be a down. So that's where we are on overall margins. So positive development is that the deal wins are contributing to some sort of a near-term margin pressure and near-term transient costs, which will go away as we go into steady state on many of these deals.
Okay, fair enough, Manoj. So then let's talk about the deal wins for this particular quarter. What can you tell us about that? Are some of these deals, if you could tell us about the size as well as the duration of some of these contracts that you guys have signed?
So we did announce a large deal with AT&T some time back, almost a month and a half back. And that's obviously a very large deal which we signed, which was a 6.5-year deal. Other deal wins, which is largely in the enterprise space, I think the normal duration will be between 3 to 5 years, and that's something which we are winning them at a steady clip, and that's something which encourages us, because even with all the global uncertainties, I think clients are willing to actually help partner with us, and we are trying to solve the problems around their businesses. How do they run them more efficiently? How do they drive change within their systems, and how do they grow revenue streams, which is in line with our strategy of run, change, grow, and that's something which is playing out very well in the marketplace today.
Okay, all right, Manoj. Then, finally, I just want to understand better. There has been an uptick in the employee costs. The understanding here is that this is largely because of the onboarding of new employees and building capacities. Is that the case in case of Tech Mahindra as well, or are there other expenses? I have an understanding that wage hikes are behind us now.
So our wage hikes are done for this year, and majority of them came in Q1, and a little portion came in Q2. I think as we look at employee costs, you're right. I think we will add employees as we go into execution mode, and so that's a component of cost which will increase. But I think from a perspective of that cost increase, that will be in line with the revenue increase, and that's something which is normal part of our business. So to me, I think if I look at, as I said, a normalized kind of margin recovery, but impacted in the short term by some of the costs towards transitioning these large deals.
Okay, Manoj, we'll leave it at that. Thank you so much for joining us and speaking to us here on BloombergQuint.
Thank you so much, Adam. Thank you.